Well, let's start off with the Fed. It is expected to make a tough call here. Officials are divided on whether they should prioritize a weak labor market or inflation. We're joined by Bipan Rai, Managing Director, Portfolio Strategy at BMO Global Asset Management. Bipan, always great to see you. Thanks for joining us this morning.
Thank you for having me.
We are hearing that there's dissent within the Fed. What should they do? Should they cut again? Should they stand pat?
I mean, there's dissent everywhere when it comes to the Federal Reserve, if you're asking me. I mean, we do have to get used to the fact that there is going to be a dichotomy between what we think the Federal Reserve will do, should do, and what they'll actually end up doing. If you take the totality of what's been said by several Fed speakers, it really does feel like the stars are aligned for a Fed rate cut for today. And then it's really all about the updated projections, because let's not forget, this is a forecasting round from the Federal Reserve. What is communicated there, is it aligned with what was communicated in September? Chair Powell's tone, is it a little bit more dovish than it was in late October? I mean, these are all things that are going to factor into how the market reacts today.
Yeah, I mean, the Wall Street Journal says as many as half of the people in the room at that Fed meeting may want to actually hold off from a cut. So it's Jerome Powell is trying to, he's trying to herd cats to some extent.
Yeah, I mean, this is the toughest time to be a Fed chair, and I would say at least a couple of decades, right? So you've got several dissenting views. You've got, at best, a fairly murky backdrop, and really how to interpret that is going to be a challenge. I mean, if you look at the U.S. economy right now, if we look at, say, Q3, Q4, we're close to 3.5% to 4% annualized. That's a great rate of growth. At the same time, you look at inflation, you're closer to the upper end of the Fed's tolerable range, so closer to 3% for both headline and core. And at the same time, yes, you are starting to see some signs of strain in the labor sector. But if you look at the unemployment rate, I mean, it's still fairly low relative to prior periods of economic slowdown in the United States. So you can make a reasonably strong case that the Fed should remain on hold today. But that's not the way the market's pricing things. At the same time, there are further cuts potentially coming in 2026 as well that we need to pay tribute to. And that's really the squaring of the message today alongside the cut is going to be something difficult, and we'll be interested to see how Powell threads the needle there.
Turning to Canada, we are hearing more and more, not predictions, but an expectation that our central bank might even start raising rates late next year.
Yeah, it's something that we're seeing not just predicated on Canadian data of late, and certainly you could talk about the string of strong labor sector reports that we've had in this country, and also the decline in the unemployment rate. I mean, let's not forget, we were at 7.1% in September. Now we're at 6.5%. That is a massive drop in 2 months. So it also tells us that the economy is absorbing slack a lot better than we thought it would heading into the second half of this year. And, you take that with, of course, the strong Q3 number that we had for GDP. Of course, the big caveat there that it was driven by a massive collapse in imports. But nonetheless, take those things. The momentum is clearly there for a potential Bank of Canada rate hike towards the end of next year. But it's not just a made in Canada story. We're starting to see this repricing also happen in several other developed markets as well, outside of the United States. And we do think that, taking all those into account, we are starting to see some of that migration towards the way the market is priced in Canada as well. And that's basically a story of why we're starting to see the market move in this direction. Now, do we think there's a degree of maybe a bit of the market getting ahead of itself? Yes, but at the same time, we do have to pay tribute to it. There are other things that could come into play, including the USMCA negotiations and how that plays out towards the middle part of next year. That is also going to be a driver of whether or not the bank actually does end up hiking rates towards the end of 2026.
We have got this plunge in the unemployment rate lately in Canada. I guess that's a worry for any central bank, or a potentially overheating labor market, or are we even close to that?
No, I think we're still fairly far away from any signs of overheating in this country. I mean, if you look at the guts of the labor force survey and what really drove that decline in the unemployment rate, a lot of it was in an area that's long been a sore spot for this country, and that's the unemployment rate amongst the younger demographics, so the aged 15 to 24-year-olds. So that's actually a fairly constructive sign. But at the very least, what it does tell us is that insofar as rate cuts are concerned, we're likely at the end of the Bank Canada's easing cycle at this point.
You say that there is a risk here that the Canadian dollar gets stronger and stronger, and that's tough on us economically in that it makes it harder to export stuff.
I mean, at the margin, that's true. It does make our exports a little bit less competitive, and you can make the case that that's probably a stronger factor now, given the fact that some of our exports, certainly the minority of them, are still being tariffed. But the first thing I look at whenever I'm looking at projecting foreign exchange rates, at least over the next 3 to 4 months, what are the relative speed directions that the Federal Reserve is moving compared to the Bank of Canada, and what are the speeds? Now, the Fed is clearly on the way towards lower rates, whereas in Canada, the Bank of Canada is probably looking at keeping rates on hold for the next little while. So if you take that into consideration, I mean, it does make sense that we could see some further gains in the loonie compared to the U.S. dollar, at least over the next 3 to 4 months. So if you are a Canadian investor and you do have exposure outside of this country to the United States, it might make sense to look at some tactical foreign exchange hedges.
Bipan, thank you very much indeed for joining us.
Thank you for having me.
Bipan Rai, kicking off the show there. Bipan is Managing Director in Portfolio Strategy at BMO Global Asset Management.